Good morning, everybody. So I will not discuss the outlook on equity markets today because there's nothing really new to highlight on US and European markets. So I prefer to focus this morning on different global macro charts. The first one is what's happening on the US dollar, which is quite important, as you will see in a few seconds. And then after that, we are going to make an update on US 10-year bond yields and also on oil prices. So if we start with what's happening on the dollar index, so as you can see, a quite important week with a new technical bounce on the 200-day moving average. So you can see it very clearly here, which looks so far similar to what we saw in February and also March. So each time since the start of the year, we are seeing a pullback on this 200-day moving average. Traders are buying the dips on dollar index and continue to do so at this stage. So this is what we saw this week, with technical bounce and a bullish reaction to oversold conditions on the 14-day RSI. So the combination of these two indicators is telling me, okay, traders are still buying the dip on the dollar index, which suggests that the US dollar possibly hit an important low last week and is due to recover with minimum between 50 and 61.8% retracement of the recent correction, and possibly prices going back above 98, which has been a pretty important resistance so far this year. So short-term outlook is improving, obviously, on the dollar index. On the other hand, if we don't validate the bull case, let's say in the next week or two, which means that in case we see an invalidation of the current technical bounce and a move back to 96.60, 96.50, then the risk will be to have some stop losses orders on the dollar index and probably the start of a significant downside acceleration to mean 96, maybe even back to year lows around 95. So we can see that right now, critical juncture on the dollar index, short-term bull case favored. So right now we are in the middle possibly of a technical bounce, possibly starting a technical bounce. But you have to be very cautious if the technical bounce fails within the next week or two. And because I think in this case we could have a lot of stop loss orders, technical stop loss orders activated with a break below 96.50. So keep an eye on this chart next week. I will update next Friday the technical view to see if the technical bounce is confirmed or not. If we now look at the euro dollar, so unsurprisingly, this is a mirror of the previous chart. So you can see that this declining 200-day moving average is providing resistance. So that's what happened this week with a failure to reach this declining 200-day moving average and start of a reaction to overbought conditions. So this is once again the 14-day RSI. So right now you can see as well a critical juncture for the euro dollar. As a reminder, so the euro dollar made a bull trap in March, and the risk is obviously to do something similar with euro dollar trying to bounce back, failing on an important resistance zone, which was obviously tested this week around 113.50, 113.60, and renewed weakness. So for me, the critical juncture will be around 112, so very important technical support, because as long as prices hold above 112, the bull case will remain possible, which means that we can make a setback, then after that a breakout attempt. But if we if the euro dollar breaks below 112, then the risk of seeing a bull trap similar to what we had in March, April, will be higher. So this will be a break below 112 will be a quite bullish signal for the US dollar, so bearish for the euro. And on the other hand, we can see that as well, as long as 112 is holding, possible start of a new technical bond. So critical juncture within coming week, obviously. If we now switch to US 10-year bond yields, so as I told you last week, following the very strong downside acceleration of US bond yields, which was the steepest, as a reminder, since the summer 2011, which was the Greek crisis, we saw a technical bounce attempt this week on US 10-year bond yields, but I mean the technical bounce so far has not been very powerful. As you can see here, yields even failed to reach 220, which was the gap opened a few weeks ago. So it was the first resistance. So the failure to hit this first resistance is sign of weakness. So we continue to see weak yields with risk of extending the slide to 2%. 2% being the next very important support, as you can see here, because it's the low of 2017. So overall, not a very bearish message on US bonds this week. So we continue to see persistent weakness on this on yields, on US bond yields, without any significant correction. So 2% potential target for this move, and 220 would be the stop loss for someone who is bullish on US bond yields. On US bonds, not yields. Okay. Last chart I wanted to show you is the chart of Brent. Brent is quite similar to what we are seeing on US 10-year bond yields. So significant downside acceleration observed in late May. Technical bonds attempt above 60. So we saw what happened yesterday. But I mean, technically speaking, the fact that we had a new technical bounce from the 60 area on Brent yesterday does not really improve the technical outlook of this market. From an Elliott wave perspective, I think we made wave 3. We completed a wave 3 in early June. The technical bounce attempt, the current technical bounce attempt, looks like a wave 4. And I think there is one more leg down missing, which would be a wave 5, probably below 60. And the ideal target would be the next Fibonacci support at 56. So I'm not really confident in the current technical bounce, and I think we can still see renewed weakness within the next few weeks. Thank you very much for listening, and have a great trading day.